In July of 2010, President Obama signed the Dodd-Frank Wall Street Reform and Consumer Protection Act into law with great fanfare, surrounded by lawmakers who promised the American people that the too-big-to-fail problem was solved, that the banks that had destroyed the economy in 2008 would be broken up, that taxpayers would never again bail out reckless financial institutions, and that Wall Street would finally be held accountable. But 13 years later, the 6 largest banks in America control more assets than they did before the crisis. JPMorgan Chase is 50% larger. Bank of America has absorbed Merrill Lynch and Countrywide. Wells Fargo swallowed Wachovia, and the derivatives market that nearly collapsed. The global economy has grown from $600 trillion to over $1 quadrillion in notional value, which means Congress didn't just fail to break up the banks. They actively made the problem worse while pretending to fix it, and, if you believe the promises from 2010, you need to understand that you were lied to deliberately, systematically, and with full knowledge that the reforms would fail. This is the story of how Congress promised reform and delivered protection, how legislation sold as restraining Wall Street actually empowered it, and how the political theater of financial regulation works to serve banks rather than constrain them. But more importantly, this is about understanding why the next financial crisis will be worse than 2008, because the banks are larger, more interconnected, more politically powerful, and protected by regulations that were written by the industry itself. And when the system collapses again, which it will, the bailouts will be bigger, the damage more severe, and your ability to protect yourself more limited, because the banks have used the last 15 years to consolidate power while convincing the public that reform happened. The origin of Dodd-Frank tells you everything about how financial regulation actually works. The bill was written in the immediate aftermath of the 2008 crisis, when public anger at Wall Street was at its peak. $13 trillion in household wealth had evaporated. 10 million families had lost homes. Unemployment was at 10%, and people wanted blood. They wanted executives in prison. They wanted banks broken up. They wanted Glass-Steagall restored, the Depression-era law that separated commercial and investment banking, and for a brief moment it seemed like real reform might happen. Senator Ted Kaufman proposed an amendment to break up the biggest banks, limiting their size to a percentage of GDP, making them small enough to fail without threatening the system. And this was common sense. The entire too-big-to-fail problem exists because certain institutions are so large and interconnected that their failure would cascade through the economy. So the solution is obvious: make them smaller. But the Kaufman amendment failed. It didn't even get a vote. It was killed in committee by senators from both parties who had received millions in campaign contributions from the financial industry. And this is where you need to understand how lobbying works. The 6 largest banks spent over $500 million on lobbying and campaign contributions between 2008 and 2010. That's $500 million to influence the very legislation that was supposed to restrain them. And the return on that investment was extraordinary. They didn't just avoid being broken up, they got regulations that protected them from competition, subsidized their activities, and made them even more too big to fail than before. The Dodd-Frank Act that eventually passed was over 2,000 pages long, and this length is important because complexity is a weapon that banks use against regulators and the public. Nobody reads 2,000 pages of dense financial regulation, which means the banks can bury loopholes and exemptions and favorable provisions in the fine print, and the process of writing those 2,000 pages involved bank lawyers and lobbyists at every stage. They sat in on drafting sessions, they proposed language, they negotiated with congressional staff, and the result was legislation that looked tough in press releases, but was riddled with escape hatches that sophisticated banks could exploit. Let me show you how. This worked in practice with a specific example: the Volcker Rule, which was supposed to prevent banks from making risky proprietary trades with depositor funds. This was a key provision meant to separate traditional banking from Wall Street gambling. But the final rule that emerged after years of industry lobbying and regulatory negotiations was so complex and full of exemptions that banks could still engage in most of the activities it was supposed to prohibit. They just had to call it market making or hedging instead of proprietary trading. And since the definitions of market making and hedging were vague and subjective, banks could claim almost any trade fell under those exemptions, and the regulators who were supposed to enforce the rule were the same people who had come from or would return to the industry, creating obvious conflicts of interest. What would you have done if you were a congressman in 2010, facing angry constituents demanding accountability, while receiving calls from bank lobbyists threatening to fund your opponent if you voted for real reform? Would you have had the courage to break up the banks, knowing it would end your political career? Or would you have voted for a bill that looked tough but was actually designed to fail, allowing you to claim credit for reform while protecting the institutions that fund your campaigns? And this isn't hypothetical. This is exactly the calculation every member of Congress made, and almost all of them chose political survival over real reform. The promise to end too big to fail was central to selling Dodd-Frank to the public. The argument was that new resolution authority would allow regulators to wind down failing banks in an orderly way without taxpayer bailouts. But this promise was always a fiction. The resolution authority created by Dodd-Frank has never been tested with a major institution, and experts across the political spectrum agree it wouldn't work in a real crisis. Because when a bank like JPMorgan with $3 trillion in assets and millions of counterparties and positions in derivatives spread across dozens of countries starts to fail, you can't wind it down in an orderly fashion. The interconnections are too complex, the contagion risk too severe, the time too short. And in that moment of crisis, the government will do exactly what it did in 2008, which is bail out the bank to prevent systemic collapse. And everyone knows this. The banks know it. The regulators know it. The politicians know it. And most importantly, the banks know that everyone knows it, which means they can continue taking excessive risks because the downside is socialized while the upside remains private. If you're starting to feel like financial regulation is theater designed to pacify the public while protecting the powerful, you're understanding how the system actually works. And if you want to learn more about how these mechanisms operate and how to protect yourself from being victimized by them, you need to subscribe to this channel right now, because we document the real functioning of the financial system, not the mythology taught in economics classes or repeated in financial media. And understanding reality is the only way to navigate a system designed to extract wealth from ordinary people while concentrating it at the top. So click that subscribe button and turn on notifications, because what comes next in this story is going to show you exactly how much bigger the banks became under the regulation that was supposed to shrink them. The data on bank consolidation since Dodd-Frank is stark and undeniable. In 2007, before the crisis, the 6 largest banks held assets equal to 57% of GDP. By 2023, that number had grown to 67%. The banks didn't just survive Dodd-Frank, they thrived under it. JPMorgan Chase went from $2.2 trillion in assets to $3.4 trillion. Bank of America from $1.7 trillion to $2.5 trillion. Wells Fargo from $1.3 trillion to $1.9 trillion. And this happened not despite Dodd-Frank, but in many ways because of it, because the regulations imposed costs that smaller banks couldn't absorb, driving consolidation, because the largest banks were designated systemically important financial institutions, which gave them implicit government backing that lowered their borrowing costs, creating a competitive advantage, and because the regulatory complexity created barriers to entry that protected incumbents from competition. Think about the perverse incentives this creates. If you're a bank executive, and you know that being too big to fail means you'll get bailed out in a crisis, you have every reason to get bigger, to take more risk, to leverage more aggressively, because the larger and more complex you become, the more likely the government is to rescue you. And this isn't theoretical. Studies have shown that banks designated as systemically important pay lower interest rates on their debt than smaller banks, meaning the market recognizes the implicit government guarantee and prices it in. This guarantee is worth tens of billions of dollars to the largest banks. It's a subsidy paid by taxpayers who will cover losses in the next crisis, and it incentivizes exactly the behavior Dodd-Frank was supposed to prevent. The derivatives market tells an even more disturbing story. In 2008, the notional value of outstanding derivatives was around $600 trillion, and these complex financial instruments were at the center of the crisis, particularly credit default swaps that nearly destroyed AIG. So naturally, one goal of Dodd-Frank was to regulate derivatives, to force them onto exchanges where they'd be transparent, and to require collateral that would prevent another AIG situation. But what actually happened is the derivatives market grew. It's now over $1 quadrillion in notional value. And while some standardized derivatives moved to exchanges, The most complex and profitable ones remained over-the-counter, where banks trade them privately, and the collateral requirements were watered down through industry lobbying, and have enough loopholes that sophisticated banks can minimize what they actually have to post. You're probably wondering how this is possible, how regulations designed to constrain an activity can result in that activity growing. And the answer is that when the regulated industry writes the regulations, they design them to achieve industry goals, not public protection, and the mechanism is simple. You create rules that appear restrictive but include enough exceptions and complexity that they don't actually bind. And then you use those rules to prevent competition by making compliance costs so high that only the largest firms can afford them, and the result is consolidation and growth for incumbents under the guise of regulation. The Consumer Financial Protection Bureau is perhaps the most instructive example of how Dodd-Frank was undermined. This agency was created specifically to protect consumers from predatory lending and financial abuse, and for the first few years it actually did some useful work, fining banks for misconduct, creating simpler disclosure forms, investigating scams, but it was set up to fail from the beginning through its funding mechanism and leadership structure. And over the years, industry lobbying and political pressure have weakened it considerably, and under certain administrations, it basically stopped enforcing regulations at all. And this cycle of creating an agency, letting it do some work to justify its existence, then gutting it through political pressure, is standard for financial regulation in America. Let me show you the specific ways banks got bigger through mechanisms that were supposed to constrain them, the stress tests that were supposed to ensure banks had enough capital to survive a crisis, became exercises where the banks helped design the scenarios they'd be tested against, allowing them to pass tests while maintaining high leverage. The leverage ratio rules that were supposed to limit how much banks could borrow were gamed through accounting tricks and off-balance sheet vehicles. The capital requirements that were supposed to create buffers were met partly with instruments that don't actually absorb losses in a crisis. And throughout all of this, the banks argued that regulations were too tough, that they were restricting lending, that the economy was suffering, when in reality they were making record profits and paying executives record compensation and growing larger every year. The comparison to other countries reveals how weak American reform actually was. Iceland prosecuted dozens of bankers after their crisis. The UK forced banks to split retail operations from investment operations. Switzerland imposed much higher capital requirements on their largest banks, but America, which had the worst crisis and the most systemic damage, did the least to address the underlying problems, and the reason is straightforward. American banks have more political power than banks in smaller countries. They employ more people, they contribute more to GDP, they fund more campaigns, they hire more former regulators and politicians, and this power translates into the ability to shape the rules they operate under. What would you do if you realized that your government had systematically lied to you, that the reform you were promised after the worst financial crisis in 80 years was deliberately designed to fail, that the banks that destroyed the economy weren't just left intact but were made stronger and more dangerous, and that the next crisis when it comes will be worse, because the institutions are larger and the regulations that were supposed to protect you are actually protecting them? Would you pull your money from the banking system? Would you protest? Would you vote differently? Or would you accept that this is how power works in America and try to position yourself on the winning side instead of the losing side? The philosophical question underneath all of this is whether democracy can survive when economic power concentrates to this degree, because Dodd-Frank proved that even after a catastrophic failure that destroyed trillions in wealth, even with overwhelming public anger, even with the political winds seemingly aligned for reform, the banks still won. They got exactly what they wanted, which was the appearance of accountability without the reality. And if they can win under those conditions, when could they ever lose? And if they can never lose, then we don't have a system where economic institutions serve public purposes. We have a system where public institutions serve economic interests. The answer from defenders of the system is that breaking up banks would reduce efficiency, that large institutions can provide services smaller ones can't, that restricting their activities would limit economic growth, and there's some truth to these arguments, but they miss the central point, which is that the question isn't whether large banks create some value, it's whether the risk they pose to the system outweighs that value. And the answer, demonstrated by 2008, and threatened again by the current structure, is clearly yes, the risks are greater than the benefits, and a system with many smaller banks that can fail without threatening the economy is better than a system with a handful of giants whose failure would cause collapse. The crime of 2010 wasn't just that Congress failed to break up the banks. Although that would have been bad enough, the crime was the deliberate deception, the elaborate show of reform that was actually protection, the 2,000 pages of regulation that looked comprehensive but was designed to achieve industry goals, the promises of accountability that were never meant to be kept, and the systematic transfer of risk from banks to taxpayers through implicit guarantees and regulatory subsidies. And this crime is ongoing. It didn't end with the passage of Dodd-Frank. It continues every day that these institutions grow larger and more dangerous, while pretending to operate under constraints. You're probably wondering if there's any way to fix this, if real reform is possible, and the honest answer is probably not without another crisis, and maybe not even then, because the problem isn't technical, it's political. The banks have enough power to shape the rules they operate under, and they use that power to prevent changes that would genuinely constrain them. And this power grows as they grow, creating a feedback loop where size generates political influence, which protects size, which generates more influence. And breaking this loop requires either dramatic political change or technological disruption that makes banks less essential, and neither seems imminent. The technological disruption is actually more promising than the political change, because cryptocurrencies and decentralized finance and peer-to-peer platforms are beginning to create alternatives to traditional banking. And while these technologies have their own problems and risks, they at least offer the possibility of financial systems that don't depend on too-big-to-fail institutions backed by taxpayer guarantees. And the banks are terrified of this, which is why they're lobbying heavily for regulation of crypto, trying to use their political power to strangle potential competitors before they can scale. And watching this battle between incumbent financial institutions using regulation as a weapon and new technologies trying to root around centralized control will tell you everything about whether real change is possible. What this means for you individually is that you should assume the system will not reform itself, that the next crisis will come, that it will probably be worse than 2008 because the institutions are larger and more leveraged, that taxpayers will again be forced to bail them out because the alternative is system collapse, and that you need to structure your financial life accordingly, which means maintaining liquidity, avoiding excessive debt, diversifying assets, and most importantly, understanding that the promises politicians make about protecting you from financial risk are lies. The system is designed to protect banks from you, not you from banks. The 13 years since Dodd-Frank have proven that financial regulation in America is captured, that the regulators work for the industry they regulate, that Congress responds to campaign contributions, not constituent interests, that reform is theater designed to pacify anger without addressing causes, and that the too-big-to-fail problem is not just unsolved but worse. And these aren't opinions or conspiracy theories. They're facts demonstrated by easily observable data on bank size, derivatives growth, lobbying expenditures, and regulatory outcomes. And denying these facts or pretending the system works differently than it actually does is just choosing comfortable delusion over uncomfortable reality. If this video has made you angry, if you're looking at Dodd-Frank differently, if you're starting to realize that political promises of reform are usually lies, and that the system is designed to extract from ordinary people while protecting powerful institutions, then you need to watch our next episode where we're going to show you exactly what banks are doing with the derivatives they were supposed to stop trading, how they're using depositor funds to make speculative bets, and why the next crisis is being built right now in plain sight, while regulators pretend everything is fine. Subscribe immediately and turn on notifications, because understanding how these patterns work is the only way to see them coming and protect yourself before it's too late. And if this explanation made you realize you've been lied to for 13 years, share it with someone who still believes the banks were reformed after 2008, because the more people who understand reality, the harder it becomes for them to keep lying.